Let's spend a few moments now with Arlan Suderman, who is the Chief Commodities Economist with FC Stone. Of course, Arlan, a longtime commodity analyst for a number of companies. So FC Stone, I guess, one of the big boys.
Well, it is an opportunity that it was just too good to pass up, an opportunity to create something new as they make a new focus and emphasis on market intelligence for their employees and for their clients, and an opportunity to take some of the talent that's there and coordinate it using the vast resources they have around the world in offices in China, South America, Europe, elsewhere, and pull that knowledge together and provide helpful information.
All right, let's get to some of that helpful information. Recently, this week, I guess, USDA report came out, surprised some folks. Were you surprised at some of the numbers?
Oh, I was surprised at some of the numbers. First of all, the yield estimates. When you get to the October report, since USDA changed their methodology in 1994, you have to respect what they do in October. And historically, when they have an increase in October, they tend to increase again in November. When you look at the range of those increases, this was at the top end, so therefore it was more than what the trade anticipated, but was within that range. I think the big surprise, though, was the adjustment to China. Readjusting back years, you never know when that's going to happen. It happens periodically, but there's no warning when it's going to happen. Significantly increasing stocks. Now, most of that's not on the global market, but it has policy implications, and particularly in the plains that has implications because it means they get a little more realistic export number now to China. That backs up supplies here. All of a sudden it starts working into ethanol again, displacing corn. So it had significant implications all the way around for the corn and grain sorghum markets. They did increase demand going into China. I thought that was good. I think there's more to go there yet. But overall, it emphasized the fact that while demand is coming, supply is more than adequate ahead of next year's harvest.
As we look, harvest in the waning days, there are some areas still that will be harvesting late into the year. But as you go, especially in the Midwest, a lot of driving, we've seen a lot on the ground, especially sorghum and corn. We'll talk about sorghum and the impact that might have on the corn trade.
Yeah, a lot more of it on the ground after the storm when we saw this week, and with the high winds and even snow in the plains. So that's a problem, and frankly, sorghum had an oversupply this year. It'll take some of those bushels off. That's hardship for the farmers who encountered it. But I know we're going to have some very slow harvesting and down milo, some down corn out there. That's going to take a few bushels off. It's not going to have an impact on the futures. It'll be more of a basis impact as it happens. We're still trying to pull corn and soybeans out of the hands of farmers. They don't like this price. I understand that. I appreciate that. End users, though, need it. And so while supply is abundant, we're trying to not only pull it out of farmers' hands, we're trying to pull it from west to east, where we have a deficit area in the east. So the basis market is active this year, much more so than many in the trade expected.
Well, the wheat, I guess what can we say about wheat? Another crop's in the ground, that wait-and-see attitude. Looks like it's been a typical of the one we've seen the last almost decade now, this time of the year.
Yeah, and you look at the discount of Kansas City wheat to Chicago, it reached about 37 to 40 cent discount. It's traded to a 51 or 52 cent discount back in 2007, so we may be targeting that. But hard red winter wheat at almost a 7-month surplus, that's just too much wheat. If we're going to have any opportunity for building on this market, it's probably going to have to be tied to the weather problems in the former Soviet Union. They're getting some showers this week. They're probably still looking at the biggest problems in Ukraine. We could see Ukrainian exports drop by maybe a third this next year. That's something we're going to have to watch. We have plenty of wheat to meet that deficit, so we're not going to run out. But as we saw in the summer of 2010, if you get a lot of headlines about it, you can get a big sharp rally in the futures to give farmers an opportunity. But that rally probably not coming until sometime closer to spring.
Overall, let's look at the big picture. Has El Nino played itself out? Is it already in the market?
To a great extent it is. Now the question is, what about the death of El Nino? And that can lead to favorable weather in the Midwest the next year or adverse weather, depending on when it peaks and how quickly it transitions. And so that'll be what we'll be watching over the next several months. Some forecasters are already calling for adverse weather in the Midwest next year. I think we have to respect that. The latest data I looked at puts it 50-50 on which way it'd go yet.
Are there some other things you're looking at into 2016?
The real concerns right now is money flow. If we had positive money flow into the commodity sector, instead of talking about surpluses, we'd be talking about tightening basis and justifying it to take prices higher. Money flow has a big impact. The Fed now is expected to raise hikes unless something unexpected happens in their December meeting. That typically, when it's so highly anticipated, results in a dollar going lower then because it's already been priced in, which I think could help the commodities bottom and money come in. Unfortunately, though, the European Union is deteriorating again. They're talking about amplifying their stimulus program. That could keep strength under the dollar.
All right, Arlan, thanks a lot. Good to see you.
Good to see you again.
Arlan Suderman, who is with FC Stone here, he is their Chief Commodities Economist. That is the Ag View. I'm Ken Rogers.